Transform your startup journey with the EnergyTech Nexus. Connect with fellow founders, access critical resources, and be part of a community shaping the future of energy and carbon tech. Your path to building a Thunder Lizard starts here. Learn more at energytechnexus.com.
Welcome back to the show. Today, I'm really excited to have with me guests from Latham Watkins. I have with me here Scott Craig and Jim Moroney. Latham Watkins is one of the world's most prestigious law firms and a major player in both energy sector and the startup ecosystem. Welcome.
Thanks. Happy to be here. And given you guys are in Houston, I'm in Austin. Jim's in the Valley, but Jim can tell you he's a Texas guy as well. So we're happy to be part of this.
Yeah, really excited to have you guys here. And this is the first time we're doing it so that we're all four virtual, but hopefully it's gonna go well. So let's start off with, just a brief introduction of both of you, Scott and Jim. Tell us a little bit about your backgrounds and then, introducing Latham Watkins and, in general, your role within the energy transition and how you're helping startups.
Hi, good morning, everybody. It's great to be on, and thank you for having us. My name is Jim Moroney. I grew up in Texas and I'm out in California now. As Scott mentioned, I went to UT Law School, graduated 1999 for those, and moved out to Silicon Valley, and have been working with startups in the ecosystem out there ever since. At the time, Latham wasn't present in Texas. We now have quite a presence there, but I didn't have a chance to stay with. I love Latham and didn't have a chance to stay with Latham in Texas, so moved out and started working with startups, and I've been doing that ever since. And I have been working with startups in the energy transition and adjacent areas pretty much my whole career, at least for the last 15 years. And I was head of our clean tech group back when we called it that 15 years ago.
Yeah, I'm we have been with Latham for about 3 years, but I've been practicing in Austin for almost 20 years doing emerging companies, startup work across industries. One of the cool things since I've been at Latham is, as Nada mentioned at the beginning, we've got a really global leading power in energy and infrastructure. And so to be able to combine our emerging company practice with our energy and infrastructure practice has really presented a lot of opportunities, I think, for startup companies to have kind of a one-stop shop for both the early stuff, and then if things go well, the later private capital needs and other needs that they have. But generally speaking, just have enjoyed. I'm from Houston, and kind of plugging back into that world a little bit. I started my career there, and after being here for almost 20 years, having a lot of exposure to what's going on there, and the excitement of what's going on there in energy tech has been a lot of fun.
So I think there's a couple of distinctions about the energy transition that makes working with startups interesting here, right? Because we're dealing with company formation and growth challenges, but at some point we're building things at a massive scale. Tell us a little bit about why that marrying of like energy and infrastructure expertise matters even for our little startup companies who hope to be big one day.
And my view on it is, having worked across industries, you've got the typical startup that might be in software, and they can just go raise venture capital, and eventually just fly and be fine. It's a little bit easier, to enter the market. I think with energy tech, venture capital helps at the beginning, but at some point, like you said, Jason, there's a lot of capital that's required for a lot of these companies, and it doesn't necessarily make sense to go the traditional venture capital route down the line. Whether it's project finance, whether it's debt, whether it's some other kind of capital, there's an inflection point with a lot of energy tech companies, particularly if there's, heavy industry or a lot of, hard science, manufacturing facilities or plants that, it doesn't make sense to fund from up top. And so I think, again, what we see is there's a lot of companies that need to find more creative ways to grow, because for two reasons. One, it's not necessarily economically efficient to do it from the top. And two, frankly, there's going to be better return for them and better opportunity to fund projects. Venture capital funds aren't used to funding manufacturing facilities, for instance.
Yeah, I think that's what makes Latham unique in the market and allows us to help our clients kind of provide advice across the chain in different areas. That you may have the more traditional West Coast VC firms that are great with startups that have the traditional path. You may have the firms in Texas that are great with the E&I and have done that historically. There's not that many places, and I don't know that there's any place that does it like Latham that can marry those two together. And sometimes, just being able to talk to clients and bring in the right expertise to help advise them, because you reach these critical points of fundraising and making strategic decisions about how we're going to do things. And it's helpful to bring in expertise that says, okay, well, look, we've advised on these, and we can tell you some pros and cons and help you think through these decisions.
One of the things that I think struck me when I first started my energy career is, in many ways, like, you can build an entire business based around contracts, really, in the energy industry, in a way that's distinct from maybe a software startup, where in the SaaS world, it's a lot about like user interface and how do people engage and retention. And here, sometimes we're talking about 10-year offtakes, 20-year offtakes, and the entire value of a business can be won or lost on how you put your very many contracts together to create and extract value. And you got to like steer for such a long time. So can you share with us how you like help the startups navigate like these really long tail, very important engagements they have to create?
Yeah, I mean, I think in our world, the sooner we get them in front of the right people, both from the legal perspective and the business perspective, the better, because you want to try to plan that future out. And you're right, like a lot of these companies, as they're building, they're all pre-revenue, right? And they're not going to get to the revenue until those contracts are signed. And that's something that, and I'm sure we'll talk about this later, but, being plugged into the industry, to the players in the industry, to know how to get into that supply chain, how to get those offtake agreements in place, or whatever type of contract you need to prove to whoever's funding you that you're going to be ready to go day one whenever your facility or whatever it is being funded. I think that's key. And again, it's all about planning from the beginning. Like, things might change, but to have a plan, like, I'm going to raise a seed and an A and get the pilot going. But once I've got the pilot going, that means I got to go find the offtakes for my big, production plan or whatever it's going to be. Having that plan up front and talking to people early, I think it is the best path. If you wait, or if you're with experts or whatever that don't have the expertise on that commercial side, because that's very different than what, like you said, than what most venture capital companies are used to dealing with. But so having folks that are familiar with the commercial aspect and those commercial contracts, which are quite complicated, whether it's an EPC agreement for constructing or these offtake agreements, you want to have someone that knows what they're doing, and talking about it early is better, because I think that maybe some entrepreneurs maybe don't fully understand the complexity. And also, kind of, they're going to get run over by some of these big companies, and they're just going to have to, take the terms if they want to deal. So,
yeah, no, that's super interesting, and it was, it's interesting also to hear, Jim, what you were talking about, how you started the clean tech department at Latham Watkins, and then how you ended up moving to Silicon Valley, and I think what I'm hearing from you guys is like, you're also bringing. There's this side of like, how do you set up a successful startup, but then scaling it to become a multi kind of $billion company at some point. But we're talking about heavy industries. We're talking about big industrial projects. And in some way, you're kind of marrying all the knowledge and expertise and experience you have in-house of working with energy companies. Is that correct?
Yeah, just to clarify, I didn't start the clean tech group, but I did run it for a few years. But I would say that back, 15 years ago, it was a challenge. We sometimes would joke that clean tech as such has gone through some troughs. We would joke that I would joke that I was also running partially running the insolvency group because I had so many clients who hit that trough of despair and never got through it. And I think part of that challenge is that the technology has to be there to get that investment to scale up. And some of those were just a little too early. I worked with several solar companies, Styon and Mia Soleil, were U.S. based solar companies that were trying to do it in the U.S. They started with the venture investment. Obviously, to really scale up was going to be capital intensive and not in the wheelhouse for those types of investors. We did bring in some strategic investors along the way or in those early rounds, but ultimately still the cost curve wasn't there for them to really make the massive investments to get through. So sometimes the timing just isn't right. And I would say there were a lot of companies that 15 years ago were just a little bit too early. What's interesting now is that things have advanced and cost curve has changed so that it's a little easier to get through that than it was 15 years ago. And I think that's going to continue on. But it's been interesting to see that over the career, and I think our presence in Texas has kind of coincided with that as well. So I think we're really well positioned at this time to take advantage of that and see companies that really are able to come through and go through the whole stage.
Yeah. And I guess what I'm also hearing from a lot of other startups and investors who come to Texas is that, in places like New York and the Bay Area, you have that a lot of experience from venture capital, and that there's a lot that we can learn from in terms of like fundraising. But then there's a lot we can learn from Texas in terms of project finance and that creativity that you spoke about, Scott, on how do you actually fund more capital intensive projects over the long term, and how we actually need a different playbook for climate tech funding than we're used to for SaaS.
Yeah, I mean, I think that's right. If you think about Houston versus maybe the Valley or New York or Boston, the money is really coming from traditional oil and gas, but the other piece that I think is there, and I think that it needs to be remembered is, these supply chains are built, and they're and the connections that the traditional oil and gas companies have, or energy companies in general, they're there, and without those connections, it's really hard for a startup company to plug into that supply chain to help with the energy transition and helping those companies enter the transition. So I think having the growth mindset and the willingness to take, I won't say gambles, but ventures from the venture capital community is important early on. But at some point, you got to bring in the people that know the industry. And not that there's not people all over the country that know the industry, but I think that those early stage investors aren't always the ones that know how to really plug in the industry. They're the ones that know how to get the entrepreneur off and running. And at some point, you've got to, depending, whether it's, geothermal or solar, or, you just have this technology, this device or widget that's going to help in the energy transition, you're going to have to figure out how to plug it into that supply chain, and how are you going to get involved. And that's where the strategics and the folks that have traditionally invested in the energy industry can be a huge help, just because they've got the connections.
One of the things that I was curious about, and maybe you can shed some light on, is there's a lot of ways to monetize, ways to go to market in our industry. And I was connecting with an entrepreneur a few weeks ago, and just introducing them to a lot of these different concepts, from a yield co to an MLP, which really seem to me to be innovations that come out of our Houston innovation ecosystem. But the entrepreneur turned to me and said, "Well, where do you learn about all these things? Because it seems like there's a lot of different strategies, and a lot of times an entrepreneur is trying to figure out how do they actually build a business model, and they're doing it at the super early stage, and then they have to turn around and explain it to investors, right? And it's not clear there's a MBA program you can go get that'll teach you all the different types of structures to extract value. Is that something that you would go to a law firm for support for? Or is that something where you'd have to go find someone in how does an entrepreneur really tackle this big hairy challenge of putting together that business model when they really don't know everything and can't know everything.
Scott, yeah, I don't know. I mean, I think that's going to be a combination. We act as advisors to our clients, not only on the legal side, but just what we've seen over the course of our careers. I've been doing this for 25 years, and you see a lot of things, and a lot of things change, and give you some ideas at least. So I don't know that we would necessarily be the resource that would help them build out the models and and figure out the financing, but we certainly would be helpful in steering them in the right direction and have the contacts. And you're probably not going to sit down with an investor who's never done a yieldco and try to explain it to them and get them to go. So that would be more introductions to the right investors, and have you talk to someone in this area and someone in this area. And so we can bring those things together and kind of help steer the client in the right direction to get more knowledgeable to help them think through those things.
Yeah, I think that's right. Like we'll have the pattern recognition. Like if we see a term sheet, like Jim probably agree. Like I'll see term sheets sometimes come in, and our client's super excited about it, and I can just see things in the term sheet that they're just red flags to me, and more often than not these days, I end up being, I think we end up being right as far as the red flags that we noted. Doesn't mean the deal doesn't happen, but it sometimes makes it harder. So I think pattern recognition helps us. But to Jim's point, we're not going to be the finance or the product guys that help kind of figure out what the best path is. But we can help navigate through pattern recognition and then finding the expertise. Like for instance, you say a yieldco or an MLP, like we've got capital markets folks that have done more MLPs than anybody. I mean, basically any capital markets attorney in Houston's done a ton of MLPs. So it's that's where we can marry, once we can help identify with the other experts, maybe what the best path is, and then find the right experts to bring in and execute. Because that's what we're here for, is to help execute on it in a way that is best for our client.
Yeah, let's dig into that a little bit in terms of the red flags that you see, because I'm sure some of our startups, want to be aware of. And there's probably a same pattern also from like the investors who give you that term sheet that they try to get away with some of these things. What are these red flags that we should be looking out for?
Yeah, I mean, some of the ones I think of are not actually very industry specific, but the one that always gets me is when you get a term sheet from an investor and it's one of your first two rounds, your seed or your A, and they're like, we're going to go raise $10 million and we'll commit $2 million of that. That doesn't mean it's not going to happen, but what it means is they're trying to lock you into exclusivity, and then they're going to go try to find the rest of the $10 million fund. I mean, I like to see a lead investor that's going to be taking most of the round, because I tend to see those deals get tougher and sometimes go sideways, because it's really just what it is. It's an investor kicking the tires. I think the other thing that we sometimes see, and I don't necessarily discourage it, but I think it makes it tougher for companies, and it might be a little bit paradoxical, but it's companies delivering their own term sheets to investors, especially early. I think it can work for like safe, like friends and family rounds, but if you're trying to go out to institutionals with your own term sheet, one, you might be negotiating against yourself and you don't even know it, based on the terms you're putting in your term sheet. But two, I would say the most traditional rounds, the ones that go smoother, we're getting a term sheet from an investor that we negotiate, and then we draft docs from there. If you're having to put your own term sheet out there to go chase money, as opposed to just pitching investors and having them deliver term sheets, I think that's usually not a red flag, but I think you're gonna have a harder time raising money that way from the people that you want to raise money from.
Yeah, a lot of times you'll hear investors say, I'm very interested once you have a lead. And that can be frustrating to hear. It's just the fact. There's a lot of investors who really, legitimately are saying that. It's not just an excuse. Sometimes it's an excuse to a friendly way to say no without saying no. But other times it really is just, it's just not our forte to set the valuation. And so we want a lead, and then we'll come in, and it can, we can help counsel clients, but sometimes they get frustrated and say, okay, well, let's just create a term sheet and see if that works. That doesn't work. Usually it means you need to go out and find a lead. And sometimes that's where you can marry around with a more traditional venture investor who is willing to lead and is willing to set some terms and then allow other people to come in alongside. And it's harder to do that because you're talking to different types of investors and trying to bring something together, but sometimes that's just what's necessary.
I mean, the other thing I'd always recommend for entrepreneurs is if they get a term sheet from somebody and they're not, I mean, if it's not like a brand name, make them introduce you to other portfolio companies and see how it's going. Obviously, they're going to try to introduce you to the best, but if I've seen investors unwilling to do that, and to me, that's a huge red flag. And as much as they're diligencing you, you should be diligencing them. Particularly again, if it's not the Khoslas or Sequoias or Andreessens of the world that everyone knows. There's a lot of folks that want to get in the game and don't have a ton of experience, and that doesn't mean they can't be a great partner, but you got to do that reverse diligence.
And what should a founder be looking for when they're doing that diligence? Number one is, do they have the money, which is what I think I heard you say earlier,
Yeah.
Right?
Right.
But what else should they be asking?
Well, I mean, I think there's that. Yeah.
But I was just saying, look, you can negotiate all the terms you want, and you do. At the end of the day, if you have to crack open those documents to make decisions, you've probably already gotten yourself in trouble. The relationship is critical, and so it doesn't matter. I mean, it matters, but at the end of the day, whatever you agree to when they come in, it's about the relationship and the relationship in the boardroom and the advice that you're getting, the connections that you're the contacts you're being presented with, the relationship, and just basically running the business together as a partner. And it's hard to do that if you don't know who the investor is, or a check is not a check. It's more than just money, and so you really have to, I think, build a relationship is how I think of it. And part of that is understanding how they've built relationships with other people. And when you get to a tough decision, I mean, a lot of times you do reach a tough decision where you have a runway and the end of the runway is coming, and you need to figure things out, and things can get a little stressful in those circumstances, and you need a good partner to help think through that, support the company, and some people are terrific at that and really build their brand around that. That's more important to them than getting better terms in the documents, and others might not be. So it's really critical to just kind of get some visibility as much as you can into how that person is going to be a partner to you and the company.
How do you guys, I was literally working through advising one of our companies here. How do you guys think about like these trade-offs of different terms like control versus valuation? And how do you teach an entrepreneur why control matters, I guess? I know this might get in some of the weeds, but and if you can give us some examples of things you look out for.
Yeah, my philosophy typically when I'm working with a founder, look, that's my relationship with the company. And early on, the founder's interests and the company's interests are almost 100% aligned as long as the founder has control of the board and the stock. As the company grows, one of my goals is to ensure, based on our leverage, that the founder, whether it's through some kind of super voting stock or just having control or whatever, continues to maintain control of the cap table and of the board. As you raise more rounds, that becomes harder and harder to do, whether it's through dilution, whether it's through you just lost leverage, or you want to take on a very important investor that has certain. So, and then when that happens, when that starts to happen, the founder's interest and the company's interest start to diverge a little bit. And there have been times when I've been, I think we've been asked by boards to exit founders because the founders lost control of the company. Well, that was our relationship, but we represent the company at the end of the day. And so circling back to your question, I think that's my goal with all of our clients, to the best of our ability to have the founders maintain control as long as possible. It again, eventually as companies grow, that may not be possible. I mean, but it's something we strive for, because that allows the founder's interest and the company's interest to stay as aligned as possible for as long as possible. We could talk about terms. Jim, I don't know if you have other thoughts on that, but I think terms just depends on who the investor is. What am I getting from this investor? Is it worth the control? Um, or is it just money? If it's just money, then maybe the control makes less sense. If it's a true strategic partnership, maybe I'm more willing to give up some control because they understand the industry or whatever. But that could be a much longer conversation.
Yeah, I think a control it's a spectrum, and at some point it is going to flip. Try to hang on to it for the founders as long as possible. And like that's not always 100%. The founder may not be the right person as the company grows into a different stage from where it started. But usually the founder is the one that has the vision, that has the drive to at least get you to a certain point. I also think, it's the stage of the company, early on, you're going to need to raise more money most likely, and to hand over the keys to an investor who can just shut you down because they don't want to keep doing it. I fight really hard against that because you never know. I mean, back to they may have decided to go in a different direction and they're not interested. And so you just really have to be careful, and especially in those early stages, not to put yourself in a position where you don't even have the ability to go out and raise additional funding.
I do want to come back to that. One of the things I found in Houston, and maybe Jim, you can comment on this. Houston has a lot of capital where it almost comes in from a position of wanting control and then kind of hiring a management team. And I've seen enough startups go out and get a term sheet where it really looks like the investor either wants majority or where they're treating kind of the founders as not necessarily those visionaries, right? It's someone who's going to execute on a plan. Yeah. And it creates a challenge in the market where you want to go off and build something, and you're not necessarily in that position. I remember seeing a term sheet for a startup where they would get I think it's called a back end promote. They would get like their equity after the company made money, and I would never see that in a technology based startup, and it makes me wonder: is that a weird vestige of just like the way Houston works, and investors need to be trained on this doesn't necessarily match up with the expectations of a technology startup, or is there something else going on I just don't really understand here in Houston? And Jim, I don't know if that's something.
Scott, you want to?
Yeah, I mean, yeah. I think the biggest, the top line thing is just they're not venture investors usually, so they can't fail. Right? Maybe they can on one, but venture investors are investing in 20 companies, and if 2 become unicorns, they're probably making a pretty good return, especially for the early stage. Whereas I think the typical Houston investor doesn't have the venture background. Like if you think of everyone that's been investing in upstream E&P that's moving their turrets to EnergyTech, they don't get it, in the same way, or that's unfair to them. That's not their return profile. Like they can't lose, and so they need to have more control to ensure that if things aren't going the way they want it to, that their LPs aren't going to be mad at them, because their LPs are investing in them for a different reason than the venture capital's LPs are investing in a venture capital fund. And I think that's the main reason. But to your point, Jason, I do think that there is some education that can be done if these companies truly want to invest in technology companies that are founder led. I think both sides need that education, because I think there's a middle ground there. I don't think entrepreneurs should be giving up control of their company unless there's very special circumstances to it early on, if they see a ton of upside in what they're doing. Obviously, money's king, and so if that's the only money you can get, it is what it is. But and at the same time, I think that entrepreneurs need to be aware that if they're looking for money from Houston, there's going to be more hooks in it than there would be if they were getting money from an early stage venture fund. It's just a fact.
And it's all the rubber's gonna hit the road really with what we work with. High growth companies, really, that's what we try to do. And if you're gonna grow quickly into a large market that could be disruptive and go from 0 to 1,000, in a few years, then that should have the return profile to allow for some more risk on the investor part. And it may just be that if you have that profile, then it may just be that in the early rounds where it's even more risky because you still have some technology risk, market adoption risk, and other things that you haven't really figured out yet, but you still have the potential for a home run. Then it may be that you marry, early stage venture in those early rounds to sort of maintain control and get through that point and sort of get to a little more of a proven technology that can then sell. Then it's maybe an easier sell. So it could be just a different time and stage of the company. You might talk to different investors. And yes, you can try to educate folks about that, but it's going to be an uphill battle sometimes to do that. And sometimes the best thing to do is to recognize where are we in our journey and what's going to make the most sense for us, which is part of what, where we started, which is, we can help, I think through those things at least, so that it's just on your mind. Like if there's not just one path, you can think about different paths and try to find what's best for you at that particular stage of the company. And that doesn't always mean you're gonna find that solution, but you can at least turn over those rocks and try.
Are you ready to lead the decarbonization charge? EnergyTech Nexus is your platform for growth, offering unique resources and expertise for energy and carbon tech founders. Join us at energytechnexus.com and start building your Thunder Lizard. So, and in Houston, we have a lot of the strategic venture arms of corporate, right? What have you seen in terms of their approach and how that's different? And, what are the pros and cons of taking investment from CVC?
In my experience, a lot of them don't lead. And so it's like, great, you got them on your cap table and they offer an entree into their network, and that's terrific. I think the ones that do lead, I think there's some obvious things like right of first refusals, most favored nation clauses, things that could like chill things, whether it's on your exit or whether it's commercially. I think there's always the concern that, if you've got one corporate VC on your cap table, then doing commercial agreements with one of their competitor companies might be harder. I've not seen that, but I'm sure that dynamic exists. I think the biggest thing is just ensuring, if it's super early, that you're not, again, it's all about control, that you're not doing something that's going to limit your ability to exit your company or raise more money. I haven't seen the CVCs be horribly grabby in that regard. Again, a lot of them don't like to lead. I think it's more the direct corporate investment, where it's the actual corporation that's investing, where we see a little bit more aggressiveness in as far as controlling what the company can do in the future.
And some of that I think may just come from number of deals and back to the question we were talking about before. If you're an investor and you come in with terms that are onerous and you miss out on the investment and it turns out it was a 100x return, you're going to be a little bit more cautious the next time you come in with terms like that. And so over time, I think as you're noticing and reacting to the competition, because it is competition for investors at the end of the day. If the company's good, you're gonna adapt, and I think a lot of the CVCs have already done that. So they're recognizing that there's some gray space in between the private equity terms and the venture terms, and you got to figure out where you are on that spectrum. But the things that, as Scott mentioned, that they do tend to care about are, look, I'm putting a foothold into this company because maybe if it does prove itself out, we want to acquire the company. And so what will be important to them are terms like making sure that they at least have awareness that there's a deal happening so they can participate. If not, and I'll write a first refusal, but fight pretty hard on that one because it does tend to chill a process if someone's got the last look at a deal, and usually you can be successful in convincing people that that's ultimately not in anyone's best interest to just have that much control. But just making sure that, look, you're not going to wake up one day and read in the newspaper that the company got sold out for money.
The other thing, I'll add with respect to corporations where we've seen involvement is at the project level as opposed to up top. So like I'm a startup and my pilot worked and now I'm doing my first project. You're getting you're getting your offtake agreements, but oftentimes there might be a corporate partner like a big multinational that you do that project with, whether it's in the form of a joint venture or some commercial arrangement. That's another way we've seen people plug in with corporate arms. And again, with the projects, what makes it nice is that that's going to be its own entity. Usually, it's going to be almost its own business. You're going to want to separate the liability from that company to your top co, and potentially this is sort of the dream for energy tech companies that have project finance in their future is you're having all these projects and each of those projects can spin out and be its own thing, like IPO that one or sell this one, and that's the dream model, I think, for a lot of these companies. And there's been a number in Houston that have, and across the country, obviously, that have tried to follow that path. And that's where I think the corporations can come in and help.
And that type of financing is going to be much more structured, obviously, and more debt-like. And you might have some government grants, you might have some tax credits, you've got some debt financing, maybe some equity on top of that. But it's a much more complicated stack. But because it could be a separate entity and a separate finance, and you're really doing that in part, separate and apart from the parent, and it requires a whole different set of skills.
Yeah.
Can you talk a little bit about some of the trends that you might be seeing in the industry, particularly with the climate tech, clean tech space, in terms of deal structures, terms, also fundraising in general? How is that going?
I mean, I think, and I'll let Jim speak to it as well, what he's seeing out there. But we've talked a lot about it. We're seeing a lot of Houston money try to get involved and trying to navigate those terms. I think the biggest issue again is like getting from that initial money that helps you develop your product to commercialization. And I think we've seen some success stories there recently, but that's still the hardest part to do. And I think what we still haven't, and Jason and Nada, you can tell me if you've seen more of it. I think at least in Texas, we still haven't seen a lot of the coastal money come into the companies that are here. And I think that one trend, it's less of a trend, but something I'd like to see is more interaction with the various players in here and then in both coasts, because I think that can open up a lot. Because I think that in the way the companies are getting funded on the coasts is a little bit more traditional venture capital. And I think it's just because of access and geography, there's just more. I think there's more opportunity, Jim. I don't know what your view on it is.
I mean, it's always easy. It's hard to say how the market is because some clients are they just fall out of bed and they've got 5 term sheets, and then if that's your experience, you're like, oh, it's great. And others are knocking on 1,000 doors. So I'd say generally speaking, over the last couple of years, good companies are certainly getting funded. If you're not quite there, it's a much bigger challenge. So it's really weeding. It's a finer filter, I would say, on companies that have been getting funded now. But some are doing great in my portfolio, and others are just hanging on, trying to get through it. But that's always be the case.
I do think there's some people that are just preternaturally gifted at fundraising. There's some founders that just, it doesn't matter what their product or their business is, they just know how to do it. And whether it's because they've succeeded in the past, they're just good at it. And so I've seen it where it's like, I don't know how this company raised money and this one didn't. I think I don't know how many times I've seen that story where I'm like, this, because it just seems like this other one's a much better play, but just the execution by the founder just isn't quite the same. But so sometimes the substance isn't really the reason. So
And going back a little,
Yeah, and one of the challenges.
go ahead, Jim.
Uh, Sorry, I was just going to say a perennial challenge with um, growth companies is it's still just not an area where you see a lot of bankers play. It's just it's almost back to the yellow flag question. I mean, when you're raising a Series B round and you have a banker involved, that can sometimes just be the red flag because the usually ideally if you have investors and they are excited about the company, they're calling they're calling people for you because nothing's better for these guys than to be able to get to share something that's exciting and going to be profitable for other investors too. Or sometimes they're so excited about it they don't want to share and they want it all for themselves. But if you're hiring a banker, it's just a tough, and there's just not that. It just isn't that prominent, at least in my. Maybe you see it differently, Scott, in Houston, but and so it does put a lot on the founders and those early investors. Which again, back to the your investors. Some investors can be super helpful in helping you raise that next round and making the right introductions, whether it's other venture funders or strategics or whatnot. It's critically important if you have that assistance. But a lot of it does fall on the founders, and some of them that's just not what their forte was. They are great technologists, but they're just not great fundraisers. So it's a lot of things have to go right for everything to come together, and sometimes it's just unfortunate. It's hard to fundraise for some.
Do you find in this like post-COVID era that people have to get on a plane and go out to California and New York, or because I think Jim earlier you said that we aren't necessarily seeing the capital come into Houston in the way we were hoping, and is that a matter of our entrepreneurs aren't spreading their net enough? I don't know if you got something.
I think
to add,
that's Scott.
Scott, sorry.
Yeah, no, I think it's coming.
Yeah.
Yeah, no, I think it's coming, but I don't know that it's. Look, I think that you've got events like the Rice event in September, the whole week you guys put together, which was great, and I think that's always drawn people to Houston to come see these companies, and those companies are from actually the ones that show up at the Rice event are all over the world. Um, so I think it's coming. I mean, Bill Gates at CERAWeek last year talked about how Houston's going to be the Silicon Valley of energy tech, and I think that there's opportunity there. I think the solution really is more the money working together, like having a Houston PE fund that's transitioned to energy tech or is playing in that space, investing alongside a name brand VC fund from the Valley. I'm sure it's happened. I mean, I think I can think of a couple examples actually, but the more that happens, where the more you can plug in the folks that can help you from a growth mindset on the VC side, and the others that can help you on the commercial side with the strategics or just the people that know the industry. I think that combination will be helpful. Flying out. I never know how helpful conferences and stuff are. I think it probably depends on the conference, but obviously going to places where there's going to be a critical mass of people that might be interested in your company is always going to be a good thing. I don't know that the Sandhill Road Tour is always effective, especially just because we're talking about the Valley, but Boston's another city in New York. A lot of those VCs that we've heard, they don't invest in energy tech anyway. So you want to find the right fund, and I think that's the other thing is like find the right fund. Don't just go to 10 funds and see if someone's going to write you a check. I think you can, and then even more narrow than that, find the right partner or partners at that fund that are the ones you want to talk to, and then try to get a warm intro. I mean, that's the best approach to me. And then if you can do it on your home soil, like if you do it in Houston, great. If you have to fly out, that's fine. But I think this is evolving. I mean, I don't think people thought of Houston as a huge technology center 10 years ago, and I think that's changing in that regard. And I say Houston, I'll say just Texas in general. So
How should this, because inevitable, this is almost the most important question, is how should founders think about valuation as you guys are seeing it play out? And I think that the data shows that in Houston, valuations are a steep discount compared to some of the activity on the coasts, and some of that's a factor of supply and demand. There's just more supply of capital. But even amongst energy and hard tech companies, it feels like there's a discount. Um, there's the financial question of how do I approach this? There's the negotiating question of how do I approach this? But where do you guys find you're counseling your founders to help them find that that deal that ultimately is at the right price?
I mean, I can tell you how we usually think about it on in the traditional venture space is that there's a little bit of a finger in the air at some stage because you haven't even gotten to the point of having, so it depends on the stage, right? I mean, once you have the good news and bad news about having customers and revenue is that now you have customers and revenue that you can start to, model around, versus sometimes it's better from a valuation standpoint not to have that, because then you're really looking at what's the end market, what's the potential here. And a lot of VCs really are just thinking of it in that sense. And okay, how much are you raising, and what percentage of the company am I going to own? So early stage round, an investor might be looking for somewhere up to 20% of the 10 to 20% of the company. So you can kind of back into that. Okay, we're raising $10 million and you want 20% of the company. That means it's a $50 million post, or 20%. And that's a lot of people really, I mean, it's as simple as that. It's how much am I investing and how much do I want to own? As the company, grows in stages, that's obviously going to change. And that may just be that it's a different mindset. That's not maybe how a lot of the Houston capital is coming in thinking about it. Scott, I don't know what you see
yeah,
there.
I'm not sure it's industry specific, Jason. I think there's a central time zone discount. I'll be completely frank with you. I don't. I can probably point to two or three Austin companies that got like really outsized valuations for one reason or another, that were eye opening. But for the most part, I the discounts that I see, sort of whether it's here in Austin or it's in Houston or just generally speaking outside the coasts, are somewhat discounted. And I think it has to do with a little bit of FOMO, and depends on the market. And like I say FOMO by investors. So if you've got just all those investors around all of these startup companies in the Valley, there can be buzz where maybe there shouldn't be buzz sometimes, just because they're all talking about a hot company. And I think um, I don't think that's necessarily, it's not great. Yeah, we want valuations to be higher, but there's a downside to your valuation being too high early on, because there's a thing called dilution protection. And if you raise, and I tell founders this all the time that want to go raise from their friends and family at a super high valuation, is if you do that, then you're going to hose yourself when the institutionals come in and say, yeah, you're not worth 10 million, you're worth 5 million. So there's, again, higher valuations always seem better, are better, will be better in the long run. But early on, if you get too greedy with valuation, even if you perform, your next round might say, look, that was way too high. We need to level set. And there may be macro factors that affect that too. I mean, we're seeing that right now. I've got a client that's doing much better than it was doing in 2021, but valuations were so outsized then that they got something that was absolutely ridiculous. And they're performing, they're meeting their numbers, but they're raising around right now that it's a 30% down round. And it's, just because of the market's changed. And we're seeing a lot of that. I think, Jim, probably you are too. I mean, it's where companies that are doing pretty well are having to do down rounds. So there is a downside for outsized valuations. Again, not saying don't go get the best thing you can get. Just know that um, you know you want to be able to support that in your next round. You don't want to get something that you're not going to be able to support with results.
Yeah, those are tough conversations. I've gone through several boom and bust cycles in my career, and I started right when the Nasdaq crashed in 2000, and so I've always been cautious of the too high evaluation, just because I've been in the trenches on too many deals over the years where the valuation has gone down, and it just makes everything more complicated. It can be done. and you work through it, and you need good lawyers for that. But and so we're ultimately there for you, but it's definitely more challenging.
And what makes it challenging? Because in some ways, the price is the price, right? If you do your process and you get a term sheet that's down 30%, like what can you do? Talk us through kind of that board meeting that makes it hard.
Yeah, I mean, this goes back to the control issue and investors' ability to block grants, and it's just human nature. People don't like to write down their investment, especially in private companies where you have the luxury of being able to close your eyes and not necessarily mark to market, even if you should. And so a lot of times you get investors who just don't want to do that. And so you can some people are even willing to trade some structure to keep valuation high. You can kind of structure into a valuation if you want. There was, in a couple of years ago, there were companies that really wanted to be a unicorn, but the market was telling them their valuation was 700, 800 million. Well, they would go to investors and say, well, I'd really like to have a one in front of the valuation. How can we get there? Okay, well, we can put some structure into this equity to give us more downside protection. And if you're willing to make that trade off, we can make it look better. So you just might have some of those conversations.
And just to clarify for me, the audience, so when you say structure, are these like terms like participating preferred or getting like or anti-dilution protection? Like it just means more terms around that class of equity?
Yeah. When I say structure, I mean any of those things. It's just a deviation from the plain vanilla non-participating preferred with broad-based weighted average, and just basically straightforward. You might say I want a participating preferred, or I'm going to have a 2x on the downside, or I'm going to have an accreting dividend that gets paid out. So there's any number of different bells and whistles you can throw on it to make it more attractive. Now, again, you're going to have to. That's going to be there for future rounds, and one of the lessons is all investors come in and look at what you've given prior investors and say, I like that. I'd like that same thing too. So I get stuck with it.
Yeah, the other issue is the math problem. So if you have an anti-dilution adjustment, that's creating more as converted shares. This is going to get really wonky, but it creates more as converted shares on your cap table. And the investor is going to say all of that goes in the pre-money. So if you have a 30% discount on valuation, it's going to be more than a 30% discount on share price. And all of those, and so it can be like a death spiral if it's too much of a down round, because every extra share resulting from the anti-dilution adjustment goes into the pre-money, which drives the price further down, which creates a bigger anti-dilution adjustment. And there's these iterative spreadsheets that we can put together to calculate it all. But I've seen deals where it was maybe a 30 or 40% discount, but because of the way everything looked on their cap table and the adjustment, it was much, much worse. And then we're now doing reverse splits to right size the cap table. So, the anti-dilution adjustments, are like, it's all manageable, but it both creates a complications in negotiation for the next rounds, or if you're trying to save that valuation. But if you're actually taking the down round, it's much more dilutive, I think, than people realize, particularly if you're raising a significant amount of money at a down round, because that's why it's weighted. The more money you're raising and the further down it is, the more of an adjustment you're going to have.
And that's particularly true, and why you don't really see them very often, almost never. I think the statistics for a full ratchet are less than 1%, maybe even less than 0.1%, because if you have a full ratchet, is an anti-dilution adjustment that says, I'm going to get for my money, for my investment, if you ever do an investment with a valuation lower than that, I readjust my entire investment as if I invested at that lower price. Well, you can't predict the future, but that may be, and usually is, it just crushes the company and particularly management and founders, because the pie isn't changing. So if you give 70% of the pie to one investor, that takes it away from everybody else, and it can really crush the company, which is why I think you just don't really see those terms. And when you do, that's usually a red flag for me, because it sounds good on paper, but if you've ever been through it and seen how it actually works, it doesn't really work.
Good. No, I think those are some really good tips that a lot of our founders can learn from. We in Houston, we think that we have all the ingredients to create these, what we call at the EnergyTech Nexus, thunder lizards of the future. So these clean tech companies that are really going to transform our energy industry and lead the energy transition. Except for maybe, the capital, the early stage capital. We're hoping that we could kind of build that ecosystem here and also attract investors from abroad. Based on your experience of, Scott, you being in Austin, Jim, you being in the Bay Area, and what you've seen on the coast, what do you think Houston is lacking, and what do you think we need to do to really position ourselves to be a leader within this space?
I think the first thing, it's just, there's going to need to be a little luck, probably. If you think about how Austin was built through the semiconductors and Dell, and then just everything that spun out of that, really created and you have the university here too. I know that, in a different industry, the medical center in Houston's been trying to figure out how to monetize everything that's coming out of there for a long time. I think they have the same capital issues that EnergyTech does. So the most obvious way is for someone to put their boots on the ground there and be a true sort of energy transition, clean tech venture fund with a significant amount of money. The other thing potentially that could come into play is if I'm not going to name any names, but there's a number of private equity funds in Houston that are starting to dabble in venture. Again, they still have the private equity mindset we talked about earlier, but as they start to see successful exits, that's going to encourage them to continue to invest in the more speculative space of venture. I think that's, you need success stories, and then it becomes the flywheel that you want to see there. So and that's why I think it's going to take time, but I think that Houston's well on its way. I mean, I can name 5 or 6 companies that are super exciting that are based there. A couple of them are our clients, so we're really excited about that too. But it's if we see them succeed and we see them exit and we see those founders get liquid and those founders then put that money back into the industry and the community, I mean, that's how it builds. Ideally there's also people that move, but I think the more realistic path will be organically, and then people will start to see, and then they'll start to throw capital in from everywhere else.
I was going to say, feel free to name drop those 5 companies that we're talking about in Houston.
Well, I mean, the ones that I think about that are doing really cool stuff that have actually gotten to that project phase, and some aren't clients, but I think of Syzygy, Metox, Semvita's done really cool stuff. There's a 4th one I'm missing that, but these companies that are have these really amazing new technologies. I know that Aura, I mean, they're more private equity than they are venture, but they've got a lot of companies that look like venture companies, are pre-revenue, and we work with a number of them. But they're super exciting, like Utility Global or BioVeritas. So there's a number that are really, I think, on their way. And again, just hopefully it starts to create that flywheel effect.
Yeah, and then I think apart from those that you named, we have these geothermal companies also coming up with Fervo and Sage Geosystems. Yeah. Mm-hmm.
Yeah. I think there's one in Austin too, a geothermal that's doing quite well. So I can't recall the name of it, but yeah.
Great. Any kind of last advice you want to leave for founders who are starting off, and maybe those who are now maybe heading towards, really scaling and entering this growth phase? in terms of like when should they be thinking about interacting with the legal team, and just in general advice that you want to give to us?
Yeah, I mean, you should always have your first call to the lawyer. That's our advice. No, no, but I mean, it is a joke about it, but I mean, it never. People are sometimes concerned. Oh, the lawyer's going to cost money. We have a ton of conversations with people who are thinking about doing something, just getting started, and I think one mistake that people make is they start working on something before forming a company, and they just figure, well, I don't want to, I'll do that later, and kind of advance things to the point where now maybe they get a term sheet because they're out talking to people in the industry, and somebody says that's a great idea, I want to fund that. Now at that point they haven't formed a company, they haven't issued themselves equity, they've got a term sheet. Now there's going to be some value there, and even just the founder getting stock in that company may have some tax complications that wouldn't have arisen if they'd just formed the company and then started working under the river to that. So sometimes it's just really simple to get a company set up and founder stock issued, so that you're working under that umbrella. And sometimes that's a mistake we see quite a lot. So, and then it's certainly helpful. Again, we're not bankers, but we can help steer in the right direction of people to talk to, and it's not easy to do. And the more people you talk to, and the more people you interact with, the more educated you're gonna be, and the better off you're gonna be. And we're certainly happy to help with founders in doing that.
Yeah, I mean, I agree with all that, and I think that know what you want to be. I mean, like, I talk to clients weekly, or potential clients weekly, and some of them, it's like I have a services company, it's going to be profitable right away, I'm never going to have to raise money, and that's awesome for you. You don't need a big law firm. Maybe call us when you're going to sell your company, but but at the same time, if like I'm going to have to raise 500K, then I'm going to have to raise 5 million, then 20 million, then my pilot project's going to get done, and then I'm going to have to do project finance, and but if everything goes well, I'm going to be a unicorn, but I just know I'm going to have, then get with a firm that can handle that whole life cycle as soon as possible. I think we scale down really, really well early stage. I think you have to. If you're working in emerging companies, whether you're with big law or small law, and ultimately, I think that you can truly be penny wise, pound foolish on the legal side. It's our job to set expectations and make sure that there's no surprises when it comes to that. But I do think that it's always going to be worth, especially the companies you guys are talking to that are part of ETN, to make sure that they've got legal counsel that can bring them through their life cycle.
Well, no, thank you.
Awesome.
Yeah, thank you for joining us. Yeah, go ahead, Nana.
No, I was just going to say that was, really, really good advice. Thank you for sharing some of kind of the pitfalls, the mistakes that founders make. What are the things that they need to be looking out for, the red flags, and in general, sharing what you're seeing in the industry, and the great work that you're doing working with these founders and helping these companies overcome obstacles and succeed.